Everybody knows that you need to be diversified. And in your father's era, diversified meant owning a dozen or so blue chip stocks and calling it a day. But in your era of investing, it means owning mutual funds, which are a basket of hundreds of stocks. And if you own a mutual fund in your 401k, IRA, or brokerage account, you've done better than your old man. But in today's day and age, one mutual fund may not be enough to get you through your entire retirement. So you may find yourself asking, do I need to own more than one mutual fund? Before I cover that, let me tell you about the different types of mutual funds that exist, as the one you own probably invests mainly in US stocks. A mutual fund is a diversified basket of stocks or companies that are selected by a manager who makes decisions on when to buy and sell them. Mutual funds are designed to track different indexes or benchmarks. The problem with having your money in a mutual fund is that with the rise of ETFs, it's put pressure on fund managers to keep up. Most managers these days are benchmarking to the S&P 500, which has compounded at 15% a year for the last decade. The managers know that if they don't keep up with the S&P 500, they're going to get fired. So what's happened is that the managers have turned their mutual funds into mirrors of the S&P 500 index. In fact, we call them closet indexers. Because if they don't do that and they underperform the S&P 500, their client's money is going to go elsewhere. They're going to get fired. So the challenge with managers duplicating the S&P 500 index is threefold. Number one, the managers have created the most expensive way to index because their method is full of hidden fees, fees that they pass on to you, the owner of the mutual fund. Number two, their turnover ratio is much higher than that of an index fund or an ETF. The turnover ratio can lead to a much bigger tax bill, a huge tax bill for you, and it can dramatically reduce your investment performance. And number three, as if those two reasons weren't bad enough, the third reason should terrify you because it can completely blow up your dreams of retirement. How? Because if your only mutual fund is just tracking one asset class, like many of them do, and that asset class goes ice cold, there's no better way to put it, guys. Your retirement is screwed. Take a look at this chart. The S&P 500 has been the hottest asset class over the last 10 years, but it wasn't always the best bet on the block. Not that long ago, the S&P 500 lost money for an entire decade. Coming off the dot-com bubble, we had the dot-com bust of 2000 to 02, followed by the great financial crisis of 08, which led to the S&P 500 losing 1% per year for an entire decade. And if your mutual fund was tracking the S&P 500, your future just went down the drain. In fact, if you retired in 2000 and were taking 5% per year out of your fund, guess what? You went back to work in 2016. So to avoid having to go back to work, or worse, being a roommate with your grandkids, I'm going to show you a better way. Notice that in the decade where the S&P 500 lost 1% per year, which we call the lost decade, there were many asset classes that had fantastic returns, doubling and quadrupling their value in that time period. So if you owned a mutual fund of international stocks, emerging market stocks, or international small company stocks, even US small company stocks, you weren't losing sleep over the S&P 500 losses for a decade. This is the ideal example of diversified investing. So in an ideal world, to have the highest chance of not running out of money in retirement, you'd be invested in multiple mutual funds tracking different asset classes. And to be a perfect student of mine, you'd own 8 to 12 mutual funds tracking all sorts of asset classes. So in addition to owning the big US companies like those in the S&P 500, you'd also own small and medium-sized US companies, those that can be found in the Russell 2000. But let's not only think of the US. You'd also own large international companies like Toyota, found in the EFI index, and small international companies like Canva. And when it comes to international investing, you can also invest in companies that are part of what's called emerging markets. And an example of this, great example, would be Hyundai, which is located in South Korea. So it's a good company located in a country that's considered emerging. And while investing in companies can provide the most gains, they're volatile. So to steady your ship, you'd also look for mutual fund investments in real estate in the form of REITs as well as bonds. Investing that diversely will help you weather all the storms in the market. Now, before you go out and start shopping for mutual funds to buy, I'm going to give you a hot tip about mutual funds. Ready? Don't buy them. They're so 1990s. Remember when I talked about those mutual fund managers? They'd love for you to line their pockets by buying into their fund. And the IRS loves mutual fund managers too, because they get to tax you extra just for making profits. The better way to diversify today is to buy ETFs or exchange traded funds. Why? Because they're low cost, they're tax efficient, and they trade for free at most major custodians. If you're now interested in securing your retirement with proper diversification, we'd love to have that conversation with you. As always, we're here to help you invest with purpose, plan with precision, and create outcomes that serve you and your family for generations to come. You can schedule a meeting with us by using the link below. And if you like content such as this, like and subscribe to the channel, share it with anybody who you know who can benefit. Word of mouth is really helping the channel grow. See you on the next one.